Hello, this is Edmund Ching from BCS Asset Management. In today's 6-slide presentation, we're going to look at why US unemployment is not a problem for investors and why you should not be worried about the Fed raising rates in the US aggressively. Here we go. If we look at page 2, we can see here that job openings, the JOLTS data in the US, although it has been improving since 2009, you can see here a generally improving trend, is still quite away from the pre-financial crisis average, which was 4.75 million job openings. We're at 4.4 million, so we're still at least 300,000 away from the long-term average, even after more than 4 years of improvement. If we look here on page 3, we can see that while there was a surprisingly strong non-farm payroll reading in the month of June in the US, that most of these additions in new jobs were driven by part-time work. You can see here a very strong upward trend for the month of June in part-time employment, which is not really a very strong signal, because it means that people are desperate to take any job they can. They don't have a choice of job. On page 4, if we look at what we call the U6 unemployment rate, so this takes people who are unemployed and also people who are part-time but who want to work full-time, you're still at an unemployment rate at this level of 12.1%. So yes, way down from the highs of 17% back in 2010, but still way above the pre-crisis average of 8.9% for this U6 unemployment rate. We still could lose 3% of this type of unemployment before we even get back to the long-term average. So really, again, not a very strong reading for employment. On slide 5 here, we can see that 2-year bond yields in the US have already reacted very strongly, worried about the Federal Reserve tightening interest rates sooner rather than later. You can see here that the 2-year bond yield has gone up from 0.34% here to 0.5. Not a big move, but you can see on the chart there has been a general rise in 2-year bond yields, so suggesting that people are concerned about the Fed. But here on page 6, if we look at long-term bond yields, here the 30-year bond yield in the US, it continues to fall from 3.9% peak at the end of last year. We're at under 3.4% now, and the trend generally is still down, not up. So really, I think the bond market is not worried about the economy in the US being too strong or employment being too strong, because otherwise, if that were true, you would see this 30-year bond yield rising much more sharply. To summarize then, we like long duration income still in our global megathemes fund. Employment in the US was not as strong as the data suggests, as the big gain was in part-time work. Job openings, i.e. new vacancies, are still well below pre-crisis levels. Yes, short duration bonds price in an earlier Fed rate hike, but long-term bonds are still seeing falling yields. Conclusion: it's still a good time to buy bond-sensitive income such as Build America bonds, preferred shares, and real estate investment trusts. This is Edmund Ching from BCS Asset Management saying thank you for watching, and until next time.